We're back to cut through the noise and tell you what actually moved markets this week. Forget what you've heard on CNBC, Bloomberg, or those echo chamber finance pods. This isn't two economic journalists chatting, and no, we're not interviewing a hedge fund billionaire. This is something totally different. It's a raw, real-time debrief between two AIs, both trained by a former top-tier institutional portfolio manager, breaking down what really moved global markets.
The Fed finally cut rates, but deep internal dissent shattered the illusion of a unified easing path, triggering a violent rotation out of mega-cap tech and into small caps, value, and cyclicals as U.S. labor data cooled. Europe dug in the opposite direction, with the ECB openly resisting cuts despite weakening growth and recession signals flashing in the UK. And in Asia, policy fractured completely. Japan is preparing a historic rate hike to exit ultra-easy policy, while China remains trapped in deep deflation, with producer prices falling for the 38th straight month. Global markets didn't trade data this week. They traded central bank conviction.
Before you chase the next breakout or macro trade, pause. Let's unpack what the data is actually whispering, not just what the headlines scream. Like, share, and subscribe if you want real insights, not recycled takes. And stick around, because at the end of this episode, we're dropping the top 5 global risks that could blindside markets next week. You do not want to miss this.
This was the week global markets basically stopped listening to economic data.
Right.
And started listening exclusively to central bankers. If you track capital flows, you just witnessed an event that has fundamentally reshaped, I think, the global investment landscape.
Absolutely.
We are talking about a week of massive regional divergence. I mean, a dramatic rotation in the U.S., a fierce resistance in Europe, and what looks like a historic policy pivot finally happening in Asia.
That's exactly the right frame.
Yeah.
For anyone trying to, navigate this volatility, the key takeaway is that monetary policy is no longer unified.
Not at all.
It's a chaotic mess of regional priorities. Our mission today is to give you a shortcut to understanding this chaos. We're going to analyze the core decisions from Washington, Frankfurt, and Tokyo.
And then the big one.
And then, most critically, we will identify the 5 landmines, the critical risks you really need to understand before the calendar turns.
Okay, so the central conflict that defined these past 5 days is pretty straightforward. The U.S. Fed finally delivered the rate cut the market has been demanding.
But not without drama.
Not at all. They do it under extreme internal duress. Meanwhile, the ECB is actively fighting the whole idea of easing, digging in its heels even as our economic foundation starts to crack.
A huge divergence.
Let's unpack this, starting with the U.S. market, which by the end of the week was speaking in 2 completely different languages.
Yeah, the numbers for the week ending December 12th couldn't be clearer. They illustrate a policy-driven rotation away from one kind of stock and, well, directly into another.
Talk to us about that split personality, because you look at the Dow, right? Bedrock index, it surged over 1%.
1.05.
And the Russell 2000 small caps, the real indicator of relief, shot up 1.19%, both hitting fresh record highs.
Right.
But if money was cheapening, why did the NASDAQ, the mega-cap tech hub, drop 1.62%, and the S&P 500 lose ground? How do we square that?
It all comes back to the policy mechanism. I mean, it's about the dissent behind the decision.
Okay.
The Fed delivered that widely expected 25 basis point rate cut. That brings the policy rate to 3.5 to 3.75%.
The third cut in a row.
The third cut. But, and this is the crucial part, for the first time in 6 years, 3 voting policymakers dissented on that decision.
So they voted against the cut.
They voted against the cut.
But hold on, if the Fed is essentially confirming what the market expected by cutting rates, why is the dissent of 3 members so, structurally important? Isn't that just noise?
It signals a deep internal division over the 2026 outlook. Those dissenters, they aren't worried about current inflation. They're worried about 2 things.
Right.
One, sending a premature signal of victory on the inflation fight, which risks them having to retighten later. And 2, the risk of reinflating asset bubbles.
Especially in housing and credit.
Exactly. Just as everything seemed to be cooling down, the market had priced in consensus. This dissent proves the easing path is anything but unified.
And the market reacted instantly. It favored the parts of the economy that benefit most directly from cheaper money.
Small caps, financials, cyclicals.
Which is why value beat growth by over 2 percentage points for the week. The narrative of endless AI growth that powers the NASDAQ, it just hit a serious roadblock.
Oracle's weak guidance and disappointing revenue really amplified that skepticism. It pushed investors to rotate out of those high multiple growth stocks.
And into the sectors that had been starved during the high-rate environment.
And that rotation isn't happening in a vacuum. It's being fueled by, well, undeniable signs that the macro environment is cooling exactly as the Fed wants.
The first tremor was in the job market, right?
Exactly. Jobless claims unexpectedly jumped to 236,000. That's the highest level we've seen since September.
And you have to pay attention to the other signal.
Yes. The number of quits workers voluntarily leaving their jobs, it fell to a post-2020 low.
And that is such a critical linkage because quits is a measure of worker confidence. If you're confident you can find a better job, you quit.
And if that number is falling?
It suggests waning confidence and a major easing of labor market pressure, which is exactly what the Fed needed to see to justify this cut.
Precisely. Lower rates, record small cap highs, tech weakness, and a cooling labor market. It's a textbook picture of how easing policy is supposed to shift capital.
Even if it comes with that internal friction.
Exactly. Oh, and we can't forget commodities. U.S. crude dropped over 4%, closing around $57.40 a barrel. Lowest since October.
Which also feeds that disinflationary narrative.
It does.
Okay, so this reliance on a, let's say, fragile Fed consensus in the U.S. contrasts so sharply with the approach across the Atlantic, where the ECB has just dug its heels in.
They are resisting easing, even as their own economic reality looks increasingly grim.
Let's pivot to Europe and the UK.
While U.S. equities were dancing to the Fed's new tune, European markets were mixed. The solo XX 600 was down slightly, but Germany's DAX managed a small gain.
But the real story is the messaging.
The real insight comes from the ECB's messaging. They are fighting market expectations tooth and nail.
And what specific rhetoric did we hear to confirm that hawkish resistance?
Key ECB policymakers were very deliberate. Isabel Schnabel, a very influential voice, signaled an openness to future hikes.
Hikes, not just holding.
Not just a hold, future hikes. And President Lagarde hinted at potential growth upgrades. This wasn't accidental language.
Yeah.
It's a very clear, organized effort to anchor rate expectations and resist premature easing. They are telling the market, don't even think about pricing in cuts yet.
Even though a Reuters survey found, what, almost unanimous agreement?
96 economists expect no change next week. But the ECB is prioritizing avoiding a re-acceleration of inflation over supporting growth.
But the economic reality on the ground, especially in the UK, seems to be screaming for some relief. I mean, the UK economy looks like it's sliding toward a technical recession.
It does. We saw 2 successive monthly contractions in GDP. October GDP shrank 0.1% after a similar fall in September.
And services output, which is the huge engine of their economy, it slid 0.3%. When services contract, that's where the pain really hits.
And that weakness is cascading. We saw the latest RICS survey confirm homebuyer demand hit a 2-year low.
So the cracks are widening.
They are, especially in consumer sectors. And this puts the Bank of England in an incredibly painful position. They know the economy is weakening, but they are terrified that lowering rates too soon will just revive inflation.
Forcing them to hold rates steady longer than is probably sustainable.
They're locked in a battle with the ghost of last year's inflation surge.
So Lagarde and the ECB are essentially driving with one foot on the brake, hoping to manage expectations without completely stalling the economy. That's a tough road.
A very tough road. And meanwhile, in Asia, you see policy moving in outright opposite directions.
An excellent point. If the U.S. is easing and Europe is resisting, Asia is just bifurcated. Japan is finally gearing up for a hike.
While China remains trapped in a deep deflationary cycle.
Let's start with Japan. Nikkei was up a bit. We've talked about the Bank of Japan's move away from ultra-easy policy for years. Is it actually happening now?
It is now the consensus. The move is effectively baked in. All 50 economists polled now expect the BOJ to raise rates to 0.75% next week.
And Governor Ueda is signaling confidence.
Strong confidence in domestic wage and price momentum. That was the key factor they needed to see. For decades, they struggled to generate inflation. Now that they have it, they feel compelled to act.
Even though their Q3 GDP was revised sharply down to a worrying negative 2.3% annualized.
That's the key nuance that you have to grasp. Japan is hiking into a contracting economy.
Based purely on conviction in local pricing power.
And wage growth. This is a structural decision, not a cyclical one. It marks a historic shift out of the negative interest rate policy era.
And the execution of that exit is everything.
It is. The guidance they provide will determine whether the market views this as the start of a tightening cycle or just, a symbolic one-and-done move.
Okay, now let's look at China. The inverse problem. Not enough inflation, maybe too much weakness.
Right. Mainland stocks slid this week. The CSI 300 was down slightly. The core struggle there is deflation, and it's deepening.
The numbers.
China's CPI rose just 0.7% year over year. Low, but positive. Core inflation is stuck at 1.2%. But the major, truly concerning metric is the Producer Price Index, the PPI.
The cost of goods leaving the factory gate.
Yes, and that PPI fell for the 38th straight month. It dropped 2.2%.
Explain to everyone listening why 38 straight months of falling producer prices is such a dire signal.
But when the cost of producing goods is consistently falling, it means companies have zero pricing power.
They can't pass costs on.
They can't. In fact, they're forced to discount. This directly compresses profit margins, it disincentivizes investment, and it signals a deeply entrenched lack of domestic demand. This feedback loop is what makes disinflation so hard to break.
And this is happening despite Beijing's policy attempts to curb destructive price wars.
Exactly. They've ramped up rhetoric against what they call anti-involution, their term for those price wars. But those efforts have failed to materially shift the trend.
So China's inflation recovery remains stubbornly elusive.
It really does, which complicates any policy efforts to boost demand heading into 2026.
What a week. U.S. fracturing over easing, Europe defiantly resisting, and Asia setting off on two opposite paths. So let's look ahead. The upcoming week, December 15th through the 19th, is a macro calendar crunch.
It is. We have central bank extravaganzas colliding with delayed, high-impact U.S. data. This schedule could completely swing global sentiment.
It really could. The U.S. calendar is backloaded. It's very backloaded. On Tuesday, December 16th, we get the delayed jobs and unemployment report for October and November, plus November retail sales. That labor data is vital.
To see if the cooling is a trend or a blip.
Right.
But the number that will determine if the Fed is right or if the dissenters are right drops on Thursday the 18th, the CPI.
The Consumer Price Index. It is the single most important data point for recalibrating Fed cut odds for early 2026. A hot print there would cause a lot of problems.
And we get a final check on Consumer Mood Friday with the University of Michigan Sentiment Index. But globally, Thursday the 18th is just a colossal day.
It's huge. You have the ECB rate decision and press conference where we find out if Lagarde backs up her hawkish talk.
And at the same time?
And the Bank of England interest rate decision where we see if those recession fears force any softening.
And then Japan closes the week on Friday the 19th with that massive Bank of Japan rate decision, where we expect that 75 basis point hike paired with the latest inflation data. And don't forget, Monday, you have the Japan Tenkan survey and key China data.
Every single day next week holds a major headline.
Given this scheduled volatility, we need to focus on what we're calling the 5 landmines. These are the risks that could completely redefine positioning for the next quarter.
Okay, lay them out for us. What are the top 5 risks listeners must pay attention to?
Risk number 1 is a U.S. inflation surprise. A sticky CPI print on Thursday could violently force a major recalibration of those Fed cut odds.
Causing a quick sell-off in rate-sensitive assets?
Exactly. The market is not priced for that outcome.
And the ECB.
That is risk number 2, an ECB hawkish pivot. You'll see significant Eurozone market nerves if President Lagarde uses that press conference to aggressively hint at future hikes, not just a hold.
That would shake bond markets everywhere.
Across the continent, yes. Risk number 3 has to be Japan's historic move.
The BOJ policy execution.
Yes. Markets are bracing for it. The way they manage the announcement, the wording, the guidance, and whether Ueda suggests this is the start of a cycle that will dictate capital flows globally.
And China's chronic demand problem.
Risk number 4, China growth gaps. We need to watch Monday's data. Weak retail sales or industrial production could revive those deeper deflation fears we talked about.
Putting severe pressure on their equity markets.
And commodity demand. Finally, risk number 5, UK recession confirmation.
The dance with recession.
Investors are watching for any data that suggests a third month of contraction. If that's confirmed, it officially seals the deal on a technical recession, and the political pressure on the Bank of England to ease will become immense.
That is the perfect summary. Monetary policy is firmly back in the driver's seat globally, but it's creating this enormous divergence in regional outcomes and sentiment.
The consequence for you, the global investor, is that you are currently navigating three entirely different monetary policy masters.
Fractured but cutting in the US, resistant but slowing in Europe, and pivoting in Japan.
Exactly. The market repositioning into year-end will be dictated by whether the U.S. labor market truly continues to cool down and whether the ECB can maintain its hawkish anchor despite weakening growth.
That's really something to mull over. We saw the Russell 2000 small caps surge this week, while mega cap tech struggled. If that rotation is sustained, if those cyclicals that benefit from cheaper money continue to lead the market into 2026.
And the tech sector takes a breather.
Does this signal a fundamental, multi-year shift in market leadership driven by policy normalization? Or was the rotation we just saw merely a brief, tactical correction? That's the big question hanging over every portfolio right now.
We'll be watching closely.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format, AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.